Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Welcome to Accredited Investor Markets Radio. I'm Christopher Cahill. Later on, we'll be speaking with Joseph Lake of the Economist Intelligence Unit about investment in sub-Saharan Africa. But first, let's talk about fish, both as investment opportunity and regulatory capture. And then we'll talk about exciting new developments with regard to Title III, which should provide greater opportunities and scope for investment in startups in fish. First, we're going to talk about catfish and a different fish that's related to catfish called sway, and one senator from Mississippi. According to the Wall Street Journal, March 23, 2015, in an article by Tennille Tracy, the most popular seafood products in the U.S. by per capita consumption in 2013 were, in order, shrimp, tuna, salmon, pollock, tilapia, and panaceus. That's panaceus, spelled P-A-G-N-A-S-I-U-S. Panaceus displaced catfish at number 6 in 2011 and has held that position since. Panaceus is a catfish-like fish raised in the Mekong River in Vietnam and shipped to the United States frozen. Panaceus is also known as sway. I know about sway because I've eaten it and enjoyed it. But why did I eat sway of all things? Well, two reasons. First, sway at the Trader Joe's where I buy my frozen fish was 2 to 3 per pound cheaper than the other cheapest alternative among the frozen fish. Secondly, because it's called sway, S-W-A-I, so that's how I pronounce it anyway. Maybe it's pronounced differently, but I pronounce it sway, which calls to mind the song Sway, S-W-A-Y, recorded by the Rolling Stones for their 1971 album, Sticky Fingers, on side 1. And Sway is one of the all-time great Saturday afternoon one too many beers groove songs. Anyway, I was sold, and I bought and enjoyed Sway. But catfish farmers in the United States are not sold. Ms. Tracy recounts how the Food and Drug Administration had been regulating sway and catfish, but in 2015, the Agriculture Department will take over said regulation, pursuant to a 2008 change in the law. Agriculture Department regulation is much more expensive because you have to meet a set of requirements and make all kinds of investments in order to meet those requirements than FDA regulation. What this means, of course, is that established catfish farmers in the United States are more easily and less harmfully to their bottom line able to meet the requirements than less established catfish farmers in the United States, and especially the Vietnamese who produce sway in the Mekong River region. The 2008 change in the law was caused by, as Ms. Tracy describes, the driving force of Thad Cochran, senior senator from Mississippi, a Republican, and Mississippi is one of the largest catfish farming states. Well, one way you can look at this is that the FDA was not as rigorous in protecting health as the Agriculture Department is. Another way to look at it is as regulatory capture, to take away my sway. That is, well-positioned economic interests in the state of Mississippi employed their senator to make it more difficult for the Vietnamese to compete. So it's true, you can't always get what you want, but if you try sometimes, you just might find you get what they need, they being the politically well-connected and established catfish farmers and their senator. Well, more on fish. We spoke last time about salmon milt, which Japanese researchers discovered can play an efficient and environmentally friendly role in separating rare earth elements from electronic waste, among other things. While electronic waste is being recycled, salmon milt, or the DNA from it, can be used to detach rare earth elements from other parts of mobile phones, hard disk drives, and circuits. We were remiss last time in failing to note that this information came to us from Chemistry World in a January 13, 2015 article by Mr. Urquhart. So it's another startup investment opportunity in aquaculture. But it doesn't stop with salmon milt. Herring are part of the picture now. Herring milt, once again, in an article in the Daily Mail, March 25, 2015, by Richard Gray. DNA molecules extracted from male herring emissions can be used to develop a new type of flame retardant material, an environmentally friendly way of protecting fabrics from fire. Current and past retardants used to protect fabrics from fire accumulate in the environment and are linked to nasty business like birth defects, infertility, and cancer. Researchers from the Polytechnic University of Turin have found, and I'm going to read from the article, that when DNA is exposed to temperatures above 200 degrees Celsius, that's 392 Fahrenheit, its properties change and cause it to form a foam. The researchers found that layers of DNA applied to cotton could reduce the amount of heat released by fire by 40% and limit the availability of oxygen to the flames. And in a more recent paper published in the journal Polymer Degradation and Stability, the same researchers found that DNA changes chemically to have this effect. The deoxyribose groups in the DNA release water when they are set alight and form a foaming gel that chars and acts as a protective shield to the rest of the material. The process is known as an it-numescent effect. The water also combines with phosphoric acid created from the phosphate groups that form part of the backbone of the DNA molecule to create a flame retardant residue. Nitrogen in each of the DNA bases also form ammonia when heated, another flame retardant. That all adds up to an investment opportunity in flame retardant materials that are environmentally friendly. This is similar to the salmon milt investment opportunity in materials that can liberate rare earth elements, obviate the need to tear into the earth to get more rare earth elements through an environmentally friendly process. Well, all that's great, but how do we get from researcher to actual production? Well, of course, that's done through investment and operations and commerce. This is our link to recent legislation that was proposed in the United States Congress that would revise the Jobs Act, specifically revising Title III of the Jobs Act to make it more effective for providing the bases for such investment. Title III of the Jobs Act is the one that opens angel investing to tens of millions of non-accredited investors. We haven't talked about it much because it hasn't been used much, because the requirements under Title III and the proposed regulations under Title III are very arduous. They limit qualified investments to $1 million or less, and they also strictly limit what non-accredited investors can invest according to the amount of income or wealth of the non-accredited investors. So it's kind of a non-starter at this point. However, the proposed legislation would alter Title III and open it up more for at least accredited investors, so that a Title III sale of securities would not have a $1 million limit. The limit would be raised to $5 million per year. The threshold at which issuers would have to provide audited financial statements would increase from $500,000 to $3 million, greatly reducing the cost of capital for smaller companies who do not then have to provide the audited financial statements. All of this is a great opportunity for accredited investors and for those who venture into these kinds of tech investments. And all of this is discussed in a recent article posted on the AccreditedInvestorMarkets.com website, also AIMkts.com. The article is entitled, Proposed Law Would Let Accredited Investors Bypass Equity Crowdfunding Portals in Title III Offerings, and it's by David Friedman. Mr. Friedman is a financial and legal journalist based in Chicago and a contributor to our website. With all that being said, let's turn to a discussion of investment in Africa. It is my pleasure today to speak with Joseph Lake about Africa as an emerging market. Joseph Lake is a New York-based member of the Economist Intelligence Unit, its global forecasting service. His position as global economist, Mr. Lake provides insight and analysis on political, economic, and business environments around the world. He advises multinational corporations, policymakers, and private clients, and he frequently writes for, or is quoted in, international media, including the New York Times, Reuters, and Bloomberg. Mr. Lake has expertise in the United States, Canada, and in emerging markets, especially sub-Saharan Africa, our focus today. Before joining the Economist Intelligence Unit, Mr. Lake was an economic advisor to the Tanzanian Ministry of Finance, and he previously worked as a hedge fund custodian in Ireland for the United States Financial Services Group, PNC. We're going to speak of Africa as an emerging market with the goal of providing our listeners with some sense of what it is fund managers should know in placing emerging markets bets. We note that in prior conversations with Larry Swedroe of the BAM Alliance, Ted Neal of Gresham Partners, and others, the ability to get alpha, the ability to get returns above market within the highly efficient United States market is highly problematic. And very often, emerging markets is cited as a place where activist managers might get some yield above and beyond the American market. And the last thing I'll say about this is that PI Online, which is the online publication service for pensions and investments, did a survey of defined contribution executives, and it found that 91% of those answering the survey cited emerging markets as an asset class that is very important to be managed actively. Well, it's good to have you with us, Joseph. So let's just start with preconceptions. Is the story of investments in Africa strictly a matter of extracting commodities?
I think that's a good question, a good place to start. And before I answer your question directly, let me just say a couple of things. One is that, as you said, this is a really interesting time for Africa. We've got low returns in the US, in Europe, in Japan. Interest rates are near zero more than 6 years after the financial crisis. And bond yields are turning negative in several countries as fears about deflation are stalking the planet. So it's not surprising that more investors are turning to emerging and frontier markets as they look for a higher return on their investments. And secondly, let me just say before talking about commodities that there is no one Africa to invest in. Africa is more than 50 different countries with hundreds of different languages. There's one country, the Congo, which is the same size as all of Western Europe. Kenya, on the east coast of Africa, has about as much in common with Liberia on the west coast as Canada does with Honduras. So when we talk about investing in Africa, I think that you really need to do your research and come prepared and gain local knowledge. It's not a monolithic entity, but it's a large number of diverse countries with really different factors driving the economies. Now, on commodities, this has certainly been one of the big investment stories in Africa over the past 4 decades. Africa is blessed with an abundance of natural resources. Everyone knows all about the oil and gas. But the investment story over the past decade has very much moved on from this. And now we're talking more, and we're getting more queries from investors about the fast-growing consumer goods market and things like that. So, touching first on commodities, by the end of this year, commodity prices will have fallen for 4 consecutive years. And that's a stark reversal from the 80s and the 90s and even the first few years of the noughties as well. The double-digit price growth that we saw in most of those years, and that was good for Africa in a lot of ways. But the fall in commodity prices over the past 4 years has pros and cons in Africa just like it does in the US. So here in the US we see that the nascent shale oil and gas industry has been damaged. Business investment is going down because of the low oil price. But at the same time, Americans are paying less for their gas at the pump, and they're paying less for heating bills. And that complex story is very much in evidence in Africa as well. So lower oil prices are problematic for the region's oil suppliers, but it's also very much beneficial for most of the continent. Lower food and beverage prices are helping to curtail inflation, but at the same time, some farm incomes are suffering as well. So to answer your question in a very roundabout way, no, the investment story is not simply a matter of extracting commodities anymore. So we are seeing much stronger trends elsewhere now. We're seeing rapid population growth, which is a big story for investors. We're also seeing rapid urbanization. More millions and millions of people are moving from rural areas to urban areas where they can be much more productive. Cities are far more productive than rural areas. And we're also seeing rising incomes on the back of some very strong economic growth across dozens of countries. So all of these trends together are creating large consumer markets. And we're seeing the shift from extractive to consumer-facing industries. And that's one of the main reasons why we're seeing a lot of foreign direct investment pouring into Africa. And multinationals are expanding their footprint to tap into these consumer markets and to take advantage of some of the trade deals that are being struck, and also the low cost of labor. Now, I don't want to get carried away here. This is not necessarily high-value consumer goods, and greater economies of scale are possible at the lower end of the market. So this is, let me say, it's like moving from selling people flip-flops to selling people shoes, rather than talking about selling luxury handbags to millions of people. But I hear a lot of people talk about how they want to get in on the ground floor, that this is the start of this economic success story, and a lot of people have compared it to China 30 years ago. You get in early and you make the right partnerships.
Yes, Joseph, about getting in early. It is still early?
I mean, it depends on your perspective on these things. I mean, if you look at China in 1978 when it first started opening up, there's some people who went there 15, 20 years later, and that still seems early for a lot of people who were very late to the party and just started operations in China 10 years ago. So it depends on how long-term your picture is, I would say. If you're somebody who's thinking about the next 10, 20, 30 years, and I think that's what you should be thinking about in Africa, because investing, depending on your investment, it can be quite, it could be difficult to, it's not as easy as it is to invest in the US, where you can move in and out of investing very quickly. I think most investors are taking the long-term time horizon in Africa and knowing that they're going to be leaving their money in these investments for 3, 5, maybe 10 years.
So I guess two things sprung up to me, and you can discuss them in any order you like, of course. One is there are some growth leaders. Could you identify a few of them? And secondly, when it comes to producing consumer goods, are there African countries which are becoming the new Vietnam or Bangladesh?
I think they're very good questions, Chris. In terms of growth leaders, I think that a lot of large international investors look for big markets. So as I said, Africa is more than 50 countries, and some of them are very small, and some of them have very small population sizes. Some of them are smaller than a lot of US states would be. And so they have very small economies, and it's sometimes not worth, if you're coming in with a multi-million-dollar investment, you want a larger market to invest in. So I think that a lot of investors will look to larger markets that are more developed. So I'm talking about South Africa, Kenya, Nigeria. These are places with very large populations that are growing reasonably quickly, and they have a lot of potential for growth in the longer term, and also Angola as well, I would say. So I think they've been some of the bigger destinations for investment over the past while. And then I think you have a second tier of countries which maybe are a little bit smaller in terms of population, maybe their economies aren't quite as large or as developed, but that they have more potential possibly for the longer term. And here I think it's instructive to think about places like East Africa, which doesn't get a lot of the headlines. So in East Africa, we can see Tanzania, Kenya, Uganda, and Rwanda and Burundi. And all 5 of these countries have formed a customs union, and they're interested in developing a monetary union. So basically, they're trying to do what the EU has done. And I think the idea behind it is quite similar, to develop a single currency and a single market, and that's what would make it more attractive for investors to invest in. But also it would mean that they increase their interdependence on each other. And again, a lot of people would compare this to the EU when it was formed in the 1950s. And one of the good reasons behind this is that it means that there's less chance of war.
Yes,
all these countries that trade together more are less likely to go to war together.
I was going to say, not only is it a question of less likely to go to war together, another similarity with the origins of the EU, the EEC, and so on, is that the countries you cited as contemplating a series of unions, well, some of them were legacy British possessions at one point, and some were legacy Belgian and French possessions, if I have Burundi and Rwanda correct. And until recently, I think former colonies and countries that shared a language tended to group amongst themselves. But here we are creating a set of unities that cross those cleavages.
Yes, absolutely, and it's very interesting. And so the East African community, which is this customs union that we've seen in East Africa, as you said, it's several different languages, but we're also quite far removed now. There's certainly a legacy from colonialism, but I think a lot of countries and a lot of political leaders want to move on from that legacy and establish a new legacy. And I think that Rwanda is a very good case in point here. So if we're talking about national turnaround stories, there are very few that are as stark as Rwanda's. So Rwanda is probably most famous for the genocide in 1994 that claimed, depending on which historical story you read, between 500,000 and 1 million lives. And it's moved from there in the space of since 1994, it's moved from one of the most successful examples of a burgeoning economy in Africa. And a large part of that is due to the Rwandan president, who is both liked and loathed, Paul Kagame. And Paul Kagame sees Rwanda as the Singapore of Central Africa. He wants to turn it into a trade hub for the region. So he wants it to become a financial and logistics trade hub. And it's really quite impressive, the turnaround here, because Rwanda is an extremely small country and it's landlocked. So it doesn't have access to ports, and it doesn't have access to a lot of the advantages that other countries in the region enjoy. And yet it has enjoyed extremely fast growth rates, large reductions in the poverty rate there, and a lot of that is due to just sensible policy. There's been large strides in ensuring the rule of law. Very few African countries have done as much as Rwanda has to curb corruption. The country is pretty much free of red tape. There's no bureaucracy there. It takes about 3 days and 2 transactions in order to set up a company. And that's really quite impressive when you compare it to other countries in the region. And then property rights are strengthening as well, which is a key to some of these countries unlocking the capital that they have inherent in the country. So those sort of turnaround stories, which I think get less attention in the Western media, which tends to focus on the sort of bloodletting and war stories, which have become few and far between over the past 3 decades. We've seen a real turnaround there. But they're the ones, it's the bad headlines that tend to get the attention of the Western media coming out of Africa. And these success stories like Rwanda's economy get less headlines.
Well, that's a very encouraging success story. You mentioned a country earlier in connection with a larger country anyway, where opportunity might lie, which really hit my ear, and that would be Angola, which was a huge disaster in the 70s and 80s, and I really don't know what's happened in there since.
Yeah, Angola is a funny one, and that's one of the economies that I would say is very much still reliant on commodities. It's the oil story that's still driving the Angolan economy, I would say, to a large extent. So Angola tends to prosper and suffer according to the global oil price. And it's still quite a closed-off economy, but it has successfully managed its oil reserves over the past few years. It's attracted a lot of international investment, but it's one of those countries where there is a small elite in Angola that is doing extremely well, and it's difficult to see if that prosperity has trickled down to a lot of the population.
Okay, I guess we're talking about almost mirror opposites with Rwanda and Angola. But let me raise 2 other issues at once, again, for you to deal with as you would. One is, I've been reading, of course, in preparation for this interview about investment in Africa and political risks, and one analyst pointed out that in her estimation, the risk of expropriation by the government is less in most of Africa than it is in China, and the risk of other forms of government interference on political basis is less in Africa than in Argentina. And the second thing I would point out for your for you to chew on is that Nigeria is huge, and Nigeria, of course, is afflicted with Boko Haram, extreme violence in part of the country. But how does that affect the investment likelihood, investment prospects for institutional investors in the U.S. and so forth in the rest of the country?
Yeah, it's fascinating, and Nigeria is really one of these stories that I could talk about all day long. Nigeria, depending on which growth projections you believe, could have a bigger population than China in 60 or 70 years' time. And the success of Nigeria is really important for the success of Africa. But as you said, political risk is extremely high in Nigeria, particularly at the moment. So we've got national and state elections due to begin at the end of this month, and they're likely to be the most closest and most fiercely contested since the restoration of democracy in 1999. And this is so important. Like, Nigeria is Africa's most populous nation. It's the biggest country on the continent. But at the moment, there's a complete lack of confidence in the poll organizers. There's concern about the volatile environment in which voting is going to take place. And there's also anxiety about the undemocratic tendencies of Nigerian politicians, if that's fair to say. So it's virtually impossible at the moment to envisage an outcome to the election that does not involve significant political instability. And that's something I think that investors are thinking about and wary of, and a lot of eyes are on Nigeria at the moment.
And that might be the case whether Boko Haram disappeared tomorrow.
Yes, Boko Haram, for the most part, I would say, is still predominantly in the north of the country, and it is an extremely important story to watch. At the moment, I think all eyes are on Nigeria's election, but Boko Haram, it's a story that has the power to shake investor confidence in the medium term, especially if some of the attacks spread more to the south, which is where a lot of Nigeria's business centers are.
Well, then what about the political risks I had mentioned otherwise, such as expropriation? Obviously, Zimbabwe, we could maybe avoid talking about Zimbabwe and talk about other places where the government might interfere with investor rights.
Yeah, I think that's certainly very high up on investors' concerns. And I think that one thing that successful investors agree on is that when you are investing in Africa, don't expect to sort of fly in and do a deal and fly out again. If you're going to be successful, you will need a very strong understanding of local conditions, and you need very good business connections in these countries. So I think that a lot of investors look for local firms to partner with, because those business connections cannot be underestimated. And again, I would go back to my initial point, which is that it's very difficult to talk about political risk across Africa. It's extremely high in some countries. It's much lower in other countries. But things have changed, and I'd say if you're looking at for a trend over the past 20 years across the continent, political risk has fallen. But I would still be extremely wary of investing in some countries.
Well, okay then, let's speak of a country where political risks are possibly at the very low end, South Africa. Is there much upside in South Africa? Are there opportunities to find alpha by investing in South Africa?
Well, we were talking about, is this still an early time to be investing in Africa, and are you getting in on the ground floor? And I think that South Africa is the flip side to that answer. South Africa is, by most definitions, a middle-income country. It is considered very different to the rest of the continent, and investors look at it in a very different light. And it has a much more developed investment framework and rule of law in place. At the same time, I would say that the returns to investment in South Africa are lower than they are elsewhere. So the risks are lower, but the returns are also lower. And South Africa really is driving the whole of the south of the continent, and we expect growth in Southern Africa to slow down it's kind of slowed over the past couple of years, and a lot of that is because South Africa is going through a lot of trouble at the moment, and it's sort of stuck in this slow growth cycle. In the same way, I mean, 5 or 6 years ago when people were talking about where to invest, and everyone was talking about the BRICS and Brazil, Russia, India, and China, and a lot of people thought that the S should refer to South Africa. And a lot of those countries have kind of fallen off the radar in terms of investment. So South Africa has gone through a lot of trouble. Brazil has as well. Russia is going to go through a recession this year. A lot of it is sort of self-imposed, but still. And South Africa is really having some teething troubles now. It's stuck in a slow growth cycle, and it's weighed down by structural issues. We do see some improvement likely to happen over the medium term, but it's also one of the countries that's more tapped into the global capital market, and that leaves it more exposed, particularly in years like this, when the U.S. Federal Reserve starts to raise interest rates, and you see a flood of capital coming back to the U.S. from all of these markets around the world, because there's higher returns now to be earned in the U.S. when when Janet Yellen eventually decides to raise interest rates. And of all the African economies, South Africa is the one that's going to be most exposed to that because it attracts a lot more of that sort of hot money investor inflows than the rest of Africa because its capital markets are a lot more developed.
Well then, to finish off this really interesting discussion, maybe I'm asking a question which is junior to the question you just answered, and that is emerging markets in general. What effect would one expect a persistently strong American dollar to have on investments in emerging markets, if that question even makes sense given what you've just said?
I think that's a really good question. And the major economic story of the year is going to be the Fed increasing its interest rates and the strong dollar that comes along with that. So we've seen, I think the dollar has appreciated by something like 20 or 25% against a basket of currencies over the past year or so, and that has a big impact on most countries in the world, not just the US. And that impact is it goes through two channels. So one, it has an impact on the trade side. So a lot of African currencies have weakened considerably over the past few months. As the dollar has appreciated, their currencies have weakened. And that does a couple of things. The stronger dollar makes African economies more competitive. So their exports that they're selling abroad will be at a lower price in dollar terms, and so they should be more competitive and able to sell more exports. The drag on this, and the big downside for African economies, is the price of oil, which is often the largest import, is denominated in dollar terms, so it drives up the import bill. Now, the second main channel that the stronger dollar comes through is in debt. So foreign investor appetite for African debt has hit record highs over the past couple of years. And debt issuance and international bank and corporate loans are playing a much bigger role in African finance than they have done in the past. But the yields on this debt are going to edge higher this year because the Fed is going to start tightening. And that's also the reason behind the stronger dollar. And as a result of that, there's a fear that some African economies could struggle to remain current on their debt servicing. So we've seen recently the IMF has cautioned that African countries are taking on too much debt, and that the currency depreciation from a stronger dollar, along with the increase in interest rates from the Fed tightening, could threaten the sustainability of this debt. And already we've seen Zambia and Ghana have sought IMF support after they've taken on too much debt over the past few years. Now, that's the danger and that's the fear, and we've gone through a lot of debt concerns in Africa over the past few decades, and we've seen a lot of debt relief granted, 2 rounds of it now, because they've gotten into a lot of trouble on the public debt side of things. The good news here is that a lot of African economies have built bigger buffers this time around, and they're much more resilient than they were in the past when we've had these debt crises. So they've actually now got much lower debt levels in general compared to the past, and they've got much higher levels of foreign exchange reserves to combat any currency worries. And they've also got stronger domestic demand. So that's this domestic consumer story that we've been talking about. People have more money in their pockets nowadays. They're able to spend more. So they're less concerned about what's happening in the rest of the world, and they can rely on their own consumers to drive growth. And they've also diversified their trade and investment ties, so they're less tied to 1 or 2 countries. So the stronger dollar is going to have an impact this year. There's no doubt about that, and it's going to raise debt concerns. But we think that Africa is in a much better place to deal with those concerns now than it has been in the past.
Well, thank you, Joseph Blake. It's been fascinating.
Thank you very much, Chris, and thanks so much for having me on the show today.
Oh, you're welcome. This has been Accredited Investor Markets Radio. I'm Christopher Cahill. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.